Ontario Keys to Community 2025 Deep Dive. If you live in or you work in Ontario, California, or if you've ever lived there, the city could give you up to $120,000 towards buying your first home. Now, this isn't a lottery, it's not a gimmick, it's a real city program, and it's called Keys to Community. And if you know how to use it, it can actually literally be the difference between staying a renter for another year or even a decade, or buying a home this year. But here's the catch. You have to qualify, and that's what this video is about. I'm going to explain the program in plain English. We are going to cover who qualifies and how they decide. We're also going to talk about how the income limits actually cap the maximum home price. I'm going to provide 3 full hypothetical buyer examples with income, debts, credit score, and complete monthly payment breakdowns for both FHA and conventional loans. That way you can see exactly what works and what doesn't. Now, before we dive in, make sure that you like this video, subscribe to my channel, and share it with anyone who's thinking about buying a home or could get value from this information. By the end, you'll know exactly whether this program can work for you, and if it can, what you need to do next. Now, what is down payment assistance? Down payment assistance, or DPA, is money that can help you cover the upfront costs of buying a home. That includes your down payment, the percentage you put down upfront, and sometimes closing costs, which are the fees that help finalize the transaction. Some DPAs are a grant, free money that you never have to repay. Other, like Ontario's program, are deferred loans. That means no minimum monthly payments for now, but you have to repay them later when you sell, refinance, or transfer title, or you finally hit that 30-year mark. Now, here's an example. Without DPA, buying a $500,000 home with a 3% down conventional loan means $15,000 upfront plus another $12,000 to $15,000 in closing costs, and that's $27,000, $30,000 cash that you need. DPA removes that upfront barrier, but you still have to qualify for the minimum monthly payments. Ontario Keys to Community. Here's the program in simple terms. You get up to $120,000 as a second mortgage. Also, it's called a subordinate loan because it's recorded behind the first mortgage. It's 30 years deferred, no minimum monthly payments on that loan for 3 decades, and it can be used for down payment and closing costs. Homes must be inside Ontario city limits. They must be your primary residence, so no rental homes or vacation homes. And priority goes to people who live or work in Ontario. You'll also need to complete an 8-hour HUD-approved home buyer course. HUD stands for the U.S. Department of Housing and Urban Development, federal agency that oversees housing programs. Now, the program can be stacked with the city's Housing Rehabilitation Loan, HRL, up to $30,000 for repairs, and the Exterior Beautification Grant, EBG, which is an additional $10,000 for curb appeal project, and that's potentially $160,000. Eligibility and credit score method. To qualify, you must first meet minimum income limits. Now, HUD updates these each year. For a household of 1 to 4, you're generally looking at $85,000 to $140,000 maximum gross income. Gross income means before taxes are taken out. 2, be a first-time buyer, meaning you haven't owned or lived in a home in the last 3 years. 3rd, count all adult household income. Even if they're not going to be on the loan, we still have to count it. 4, meet credit score minimums. FHA, Federal Housing Administration, usually means that you need a 640 minimum credit score. FHA loans are government-insured mortgages with more flexible credit guidelines. Conventional loans, these are mortgages that are not backed by the government, usually require a 660 to 680 minimum. Now, CalHFA, California Housing Finance Agency, specifically, if your DTI, debt to income ratio, is over 45%, you can go up to 50% if your credit score hits that 700 minimum. How your credit score is determined. Lenders pull 3 scores, one from Equifax, one from TransUnion, and one from Experian. Now, they take the middle number. For example, if your Equifax score is 727, your TransUnion score is 682, and Experian is 701, the middle credit score is 701. That's the number that they use. Now, income limits and maximum purchase price. The income limits don't just decide if you're eligible. They also cap how much house you can realistically buy. If the maximum allowed household income is $120,000 a year, you can't qualify for a $1 million home because the minimum monthly payment needed to get that loan would require a much higher income, and that would push you over the program's income limits. So let's run the math under current rates and typical expenses for Ontario using the program's DTI caps. FHA loan at 5.87 6.75% with 0.55 annual MIP, mortgage insurance premium, plus taxes at 1.25%, homeowners insurance of at least $1,800 to $2,400 a year, which is $150 to $202 a month, with no homeowners association. For a household at the top income limit of $120 a year, the realistic purchase price is about $520,000 to $540,000. Conventional loans at 6.875 with 0.69% annual PMI, private mortgage insurance plus the same taxes and insurance for that same income, realistic max purchase price is about $500,000 to $520,000. Now, if you're buying a condo with $325 a month of HOA dues, homeowners association fees, these max purchase prices drop by $40,000 to $50,000 because the HOA counts in your DTI. And if you're finding this breakdown helpful so far, hit that like button, subscribe, and share it with someone you know who's been talking about buying a home. Scenario number 1, FHA. Let's say you're buying a condo with FHA financing. Our first hypothetical buyer, household income $95,000 a year, $7,916 a month. Middle credit score 675, debts $450 a month for a car payment, $150 a month for credit card payments, $600 total. Now you're buying a $500,000 condo in Ontario. HOA dues are $325. Loan terms with Ontario down payment assistance. First mortgage $482,500 at 5.875% for 30 years. MIP, mortgage insurance premium 0.55% of $482,500 is $2,654 a year at $221 a month. Taxes $520 a month. Insurance $150. MIP $221 a month, HOA $325. That's a total of $4,066 a month. Let's break down the debt to income ratio. DTI now, $4,066 for the house, $600 for the monthly expenses divided by the gross income of $7,916 is equal to 59%. That's too high for FHA's typical cap of 40 to 50%. The result does not qualify. The price is too high for this income and debt level. Now, scenario 2, conventional condo buyer that does not qualify. It's the same buyer, but with a conventional loan. The down payment is 3%, which is $15,000, and it's covered by the down payment assistance program. The first mortgage, $485,000 at 6.875% for 30 years. PMI, private mortgage insurance, is factored at 0.69% of $485,000. That's $3,347 a year or $278 a month. Taxes, $520 a month. Homeowners insurance, $150 a month. HOA dues, again at $325. The monthly payment, principal and interest, $3,182. Taxes, $520 a month. Insurance, $150 a month. PMI, $278. HOA, $325 for a grand total of $4,455 a month. DTI, $4,455 for the house, $600 for the expenses monthly on the credit report, divided by $7,916. The gross monthly income gives us a 63.9% debt to income ratio, which is well above conventional guidelines of 40 to 50%. Result does not qualify. The monthly payment is too high for the income. It's not all bad news. I'm going to give you a success story. Scenario number 3. Now let's look at a buyer who makes it work. The household income, $110,000 a year, which is $91.66 a month gross. Middle credit score 700. The debts, let's say a $300 car payment, $150 in minimum credit card payments is equal to $450 a month. They're buying a $450,000 single family home with no HOA. FHA's loan with Ontario down payment assistance. Down payment is 3.5%, $15,750, which is covered by the down payment assistance. First mortgage, $434,250 at 5.875%. MIP at 0.55% of $434,250 equals to $2,300 a year or $199 a month. Taxes, $56.25 a year or $469 a month. Homeowners insurance, $150 a month. Monthly payment, principal and interest total, $2,567. Taxes, $469. Insurance, $150. Mortgage insurance, $199. That's a total of $33.85 a month. The DTI, $33.85 plus $450 divided by the $91.66 equals $41.8, comfortably under limits. The result qualifies under the DTI and income caps. Payment is manageable. Now we're going to talk about equity sharing. Equity sharing means that when you sell or you refinance a home, the program takes back the original loan amount plus a percentage of the home's appreciation. Appreciation is just the increase in the value from what you paid to what you sell it for later or what it's worth later. Here's an example. If you buy a home for $500,000 and later sell it for $600,000, the appreciation is $100,000. If the program's equity share is 20%, you would owe them the $20,000 plus paying back the original loan. Now, here's how some of the major programs handle equity sharing. Ontario Keys to Community. Yes, they have equity sharing. CalHFA, Dream for All. Yes, they have equity sharing too when that program is available. CalHFA's My Home. There's no equity sharing. Riverside County Down Payment Assistance. No equity sharing there. LA County HOP. Yes, equity sharing applies. For LA County HOP, by the way, that stands for Home Ownership Program. It's run by the Los Angeles County Development Authority. And there are two versions. HOP 80 for buyers earning up to 80% of the area median income with up to $100,000 in help. And then there's HOP 120, and that's for buyers earning up to 120% of the area median income with up to $85,000 in help. Both require at least a 1% down from your own funds, income and purchase price limits apply, and completion of HUD's approved home buyer course. The loan is deferred, which means that no payments are due until you sell, refinance, or transfer title. And yes, it comes with equity sharing. Now that you know which program requires equity sharing, let's compare all of them side by side so you can decide which one works best for your situation. Let's do a quick side-by-side comparison of the major programs so you can see how Ontario's Keys to Community stacks up. Ontario Keys to Community gives you up to $120,000. It's deferred for 30 years on a 30-year loan, and there's no minimum monthly payments until you sell, refinance, or transfer title or hit that 30-year mark. Minimum credit score 660. Yes, this is an equity share when you sell, and yes, it can be combined with other programs. Best use case, perfect if you live or work in Ontario and want the largest possible local down payment help. CalHFA My Home provides between 3.5% and 5% of your purchase price. That's about $15,000 to $30,000 for most buyers in this market. Also a deferred payment loan. Minimum credit score 660, but if your debt to income ratio is over 45%, you need at least a 700 credit score. No equity share on this one, and it can be stacked with other programs. Best use case, great statewide program if you don't want equity sharing and your purchase price is moderate. Riverside County DPA gives up to $120,000. It's a deferred payment loan. Minimum credit score 640 to 660, depending on the lender. There's no equity share, but it can be combined with other down payment assistance programs. The best use case, it's ideal if you're buying a home in Riverside County and you want a large amount of assistance without equity sharing. LA County HOP. By the way, HOP again stands for Home Ownership Program. Maximum help is $100,000 for HOP 80 or $85,000 for HOP 120, depending on your income tier, which is based on the area median income. Deferred payment loan with a minimum credit score of 660. Yes, there's equity share when you sell, and no, it cannot be stacked with any other programs. Best use case, best for LA County buyers in eligible areas who can benefit from big assistance amounts and don't mind equity sharing. Final advice, Keys to Community can be life-changing, but only if the numbers work. You can't stretch the income limits to buy a luxury home. HOA fees, PMI, taxes, and insurance, which can now easily run $1,800 to $2,420 a year, all count in your DTI. If you want to make it work, number one, get pre-approved early and with a city-approved lender. Number two, know your middle credit score. Number three, keep debts low to boost your buying power. Funding is first come, first serve. If you're eligible, act quickly, but be realistic. This program is a tool, it's not a magic wand. Quick note, before we wrap up, just a couple things to keep in mind. First, the income limits and purchase price caps for this program change every year. So even if you hear a number from me today, make sure you double check the latest City of Ontario application packet or intake form for the exact 25 or 2026 numbers. Second, if you hear an equity share percentage like 20%, don't assume it's the same across all programs. Always verify the city's most up-to-date program guideline. And lastly, most down payment assistance programs require to put some money from your own pocket, usually about 1% of the purchase price. It's smart to confirm if Ontario's program has that requirement before you start planning your budget. These are all small details, but getting them right could make or break your approval. If you got value from this video, hit like, subscribe to my channel, and share it with someone you know who's thinking about buying a home or someone who could benefit from this information.